Lots of chaos and lots of people angry at our approach.
It was August 19th, 2004, listing day for a highly anticipated tech IPO.
Google, the #1 internet search engine, is now searching for investors. It won't be hard. The company intends to raise $2.7 billion through an auction.
So it was chaos.
This is Lise Buyer. She was one of the architects of the unconventional listing.
The key to the auction was we asked every investor to put in how many shares they wanted at each price. How many shares do you want at 70? How many shares do you want at 75? How many shares do you want at 85? And the other thing we said is everybody, whether you are Fidelity, the largest fund manager at the time, I think BlackRock is now, but Fidelity, or whether you are, Mary Sue Smith, you're all going to get the same percentage of your winning bids. So Mary Sue Smith puts in a bid for 100 shares. Fidelity puts in a bid for 3 million shares. They will both get the same percentage of the shares they wanted at or above the IPO price. And that made many people angry because there was no discretion. It was, you tell us what you want to pay and we will treat you equally.
We're going to take a closer look tonight at one of the most anticipated public stock offerings in recent years.
Half the team flew to New York to ring the bell.
Shares of Google, the company that makes the world's most popular internet search engine, went on sale to great fanfare today.
And Larry, for instance, Larry and Eric and a bunch of folks went to New York, and then Sergey and I and some other folks stayed back in California, dotting the I's and crossing the T's on some of the things that needed to be done. And so I was not in New York. We went to the office, a Morgan Stanley office in Menlo Park, or not very far from where the office was. And we waited and watched. Literally, this is the day of the deal to see where's the stock going to open. Because you allocate it the night before. You say, are they going to hold those shares? Are they going to buy more shares? Are they going to dump their shares? What's going to happen? And we sat there and we sat there and we sat there, and nothing happened because they were still juggling, which is common for an IPO. And then the crossing price had been 100, the IPO price was 85, the opening trade was at 100, up 17%, which was right in the sweet spot of what we wanted, 15 to 20%. The stock jumped up a little bit, jumped down a little bit, closed the day at 100. For all of the kerfuffle, it turned out to have worked perfectly. And then we all collapsed for a couple days and went back to work.
This is The Closer, a show about how deals change the world. I'm Amy Keene. Lise Buyer is today known as the IPO Whisperer. She runs a consulting firm advising companies on initial public offerings. And back in 2004, she was one of the financial experts working inside Google.
I learned the biggest lesson, which is because that's the way it's done, is almost always the wrong answer.
Google took the traditional way of going public, flipped it on its head with a dirty Dutch auction, and defied Wall Street. How they did it? When we come back. In the mid-90s, Lise Buyer was working in finance on the East Coast for a big investment management company, T. Rowe Price.
T. Rowe Price, at the time, had the largest dedicated technology investment fund, meaning a fund dedicated strictly to technology stocks in the country. And I had been an investment banker. And after a while of telling other people what to do, you begin to wonder what would happen if you were the one doing it. So instead of telling other people, buy this stock, sell this stock, I wanted to buy this stock, sell this stock. So that's why I went to T. Rowe in the first place. But for better or worse at the time, and, recall dinosaurs were still roaming the earth, and we didn't even have email in the beginning. T. Rowe was based in Baltimore. Everyone who worked for T. Rowe was based in that area. There were no investment professionals on the West Coast. The edge, if you will, comes from what you know that other people don't know. And increasingly, and particularly with this whole new era emerging, not unlike what's happening now with AI, but with this whole new era emerging, I knew I needed to spend more and more time out in California, in Silicon Valley, where it was all happening. That's what caused me to leave T. Rowe and move to California and sort of say, wait a minute, nobody knows the internet from an investing perspective any better than I do, because nobody knows it at all. So let's go see what we can learn. And again, one can draw parallel to AI right now. Nobody really knew where it was going. And you knew that there were going to be hundreds, if not thousands of companies that would swan dive into the pavement and do nothing, but something would emerge. And the only way to try to figure it out was to be right in the middle of it.
Lise found a way to be right in the middle of it. She moved to the Bay Area, first working for an investment bank for a couple of years as a research analyst. Then she set her sights on investing as a venture capitalist.
So I decided if I was going to be any good, I'd better go work for a company. So quit being a VC, go work for a company. So it was at that point that I picked up the phone and smiled and dialed to say, okay, hey, I've got a big hunkin' finance background, and I certainly speak fluent Wall Street, but I do not know how your business works. One of the people I called was a fellow who had recently joined a search engine company in Mountain View.
The company had a funny sounding name, and it was one of many search engines. Today, it's the noun and verb we use all the time. Google. Here's what Lise pitched to her contact.
I know a lot about IPOs, and I know a lot about Wall Street, and I know you are nowhere near going public, but someday you will be. If you all would consider hiring me and putting me to work in the finance department, doing whatever it is finance department people do every day, I will, literally the words I used, pay you back for that education when the time comes by helping you with inside baseball, if you will, on the IPO.
Yeah, in hindsight, it sounds like you basically wasted no time, but I'm sure in the moment it didn't seem so clear what that timeline was going to look like. What were those early weeks, months? What was it like to have to make that switch?
Yeah, it's a fun question. There's the tangible, and then there's the actual and important. From a tangible point of view, I went from my big fancy corner office with lots of windows and black cars picking you up, taking you places. I went to a totally interior little officey thing that I shared with someone else. No window, in fact, no view of the outside at all. So there's the adjustment to how the real world works as opposed to how the investment banking world worked at that time. And then when you're outside looking in, you think things, pretty much run like clockwork. And you get inside and you discover that it's just chaos. And, we were keeping track of financial things on Excel spreadsheets as opposed to and by hand. And the company was growing so fast that it just hadn't really had time. This is no offense to anyone who was there before. Just nobody saw the speed. Well, I don't know, maybe Sergey and Larry did, but most of us didn't know that it was going to do what it did as quickly as it did. And so the eye-opener was how much needs to be patched up and fixed and built on the fly. And that was extremely eye-opening to me.
You mentioned Sergey Brin and Larry Page, of course, the co-founders. What were they like?
Sergey's always been the more outgoing. Larry's always been very contemplative. I mean, that both are. I think the biggest observation I take away from those days is it's difficult to have two founders. And sometimes we'd be in these management meetings and they would disagree with each other. And then they would go away. And then they would come back to the meeting aligned. And it was really impressive to see that because they're different people with different personalities and different outlooks on the world. But they were really impressive. We all had lunch together. We had a chef, and companies didn't have that at the time. And so we'd all go through and go through the tray, and we had great food. And then you just sit down with whoever you sat down with. And they were, they were there to mix and mingle with everybody else. There was no rock starness at the time.
When Lise joined Google in 2003, there were no immediate plans to go public. But a rule from the Securities and Exchange Commission, the SEC, changed the dynamic for the company.
And the rule was called the 500 shareholder rule. Well, it might have had a technical name, but we called it the 500 shareholder rule.
The rule stipulated that once a company reached 500 investors or shareholders, it had to start reporting financial data to the Securities and Exchange Commission, and Google was quickly approaching that threshold.
And not only did you have to disclose that information to your shareholders, you had to do a public SEC filing called a Form 10 that anybody, shareholder or not, could see. So we knew that we were going to have to file a Form 10 in early 2004. I can't remember what year it was, early 2004. The founders decided as long as we were going to have to tell people how we were doing financially anyway, let's use that as the catalyst to cause us to go public.
The threshold for this rule would later be changed after some big banks and VCs lobbied the agency, but it was very much in play for Google in the mid-aughts. I just want to understand something, because you think an IPO can serve a few different purposes. It's a chance for early investors to exit, to cash out or cash in, if you will. It's also a chance to raise money. And it's also symbolically, I think, quite important for the trajectory of a company. What was it that the Google founders felt was so important about going forward with an IPO at this moment? Why go all the way to an IPO and not just make the disclosures as needed?
So one, of course, I'm speculating because I am not one of the founders. And so I was not in the room where they had that conversation. But I think they really firmly believe two things. Well, they believe many things, but two important things. One was, a lot of the early employees had kind of rolled the dice going to work for this unknown. We weren't the first search engine. We were like the fifth search engine, and maybe it would work and maybe it wouldn't work. And I think Sergey and Larry were very cognizant of that. And two, they also recognized that the business grew the way it did because of all the individuals out there who clicked on the ads, right? That's where the money came from, were those little ads, and you clicked on the ads and a couple of pennies went to Google. And I think they felt very strongly that they wanted to afford the rank and file to participate in the growth of this company. Why not, to use the old cliche, share the wealth with the people who helped us get here? And it really was a firm belief in letting individual investors take part and benefit from what they were building.
Now it was Lisa's turn to deliver on that pitch she made the Google executives when they hired her. But instead of working from a boardroom at the company's headquarters, the meetings it would take to put this IPO together started at a local Denny's, the diner chain.
So IPOs tend to get employees very excited, and everyone starts dreaming of the new Ferrari they're going to buy. And to the extent that you can keep it under wraps, because it is a long, slow process for very good reasons. So we wanted to keep it very secret.
We being a small group that typically included Google's general counsel, its CFO, CEO at the time, Eric Schmidt, and the founders.
And the very initial meetings, and the first ones were even before I got there, were held at a local Denny's. And so the whole Google IPO project became Project Denny's. And that's where the meetings happened to just begin to sound out what we were going to do. And it was super clear that the founders had some very different ideas from traditional Wall Street paths to IPO. But anyway, Project Denny's, meeting at Denny's. Have those hash browns.
Can you describe, once you were in some of those early meetings, like what the mood was? Was there consensus on how to move forward? Was there disagreement? Was there tension? What, before, the idea got into a prospectus or anything like that, what was the kind of conversation about how everybody involved in that, that small group of people, how was everybody feeling about this?
Certainly, particularly these founders were unconstrained by historical precedent. When you come from Wall Street or the investment world, you see things a certain way. I certainly did. And they saw things very differently. And I was like, you can't do that because that's not the way it's done. And they, in explaining why they've been so successful, were like, why? Why can't we do that? And eventually it was very obvious to me that I was completely wrong and they were completely right. And the answer is, don't tell me that that's not the way it's done. Tell me why I can't do it the way I want to do it. And let's break the whole thing apart. So the direct answer to your question is there was a fair amount of back and forth early on. Well, they explained what they wanted. And from the beginning, it was clear that most of what they wanted made rational sense. Again, they wanted to treat all investors fairly, not just the big institutions. Sergey and Larry built Google based on what they believed, not based on what outside advisors told them. But there was certainly, as the founders laid out more and more of their vision, there was an increasing amount of dissent in the room. But early on, I probably was the stick in the mud because I had come, again, from the Wall Street background. And then you wake up one day and you realize that you didn't build a company, they did. And if they want to do something differently, well, the answer isn't no. The answer is let's find out if we can.
I wonder if you could help us understand a little bit about what that traditional IPO process usually looks like so that we can better understand what Sergey and Larry were so averse to. What usually goes down in a traditional IPO that they really wanted to do differently, to stay away from?
Yeah. Usually, the whole process is geared toward selling shares to professional investors, to institutional investors, to Fidelity and T. Rowe and Capital Group and, pick the name. Again, Sergey and Larry felt very strongly that individuals should have the opportunity to understand the business and invest in the business. Now, there's a little twist there, which is there is no Mr. Fidelity. There was a Mr. T. Rowe, but that was a long time ago. Fidelity and T. Rowe and Capital, those groups are all, the money they're investing is the aggregation of lots of little individual investors who maybe have $1,000 in an account. But nonetheless, they wanted this to be on an equal footing. A couple of examples. One of the things that usually happens is companies will go on a roadshow and go visit the institutions and have a face-to-face conversation with them about, here's what we do, here's why we're special, here's how we think it's going to work out, please invest with us. And it had only been done once before at Kraft Foods. When it went public, did this too. Sergey and Larry wanted an online video that any individual investor could watch so they could get the same roadshow benefit that the institutions got. Unheard of. But we put together a Meet the Management video. And again, Kraft Foods had done it before we did, but that's a really cool idea. And it made institutional investors very upset because they didn't get any information and I shouldn't say all, but many of them, they didn't get information. The retail investors and the press just raked us over the coals for that. Well, let's see, we did the Meet the Management meetings, and then we did in New York, we did a sort of a open meeting for people to come literally meet the founders, come into the room and shake hands and meet the founders. That was unusual. I guess those were sort of two, there were so many things that we did differently, but there's an example of how they wanted to put, again, their original motivation for going public, they wanted to follow that through.
Google wanted to speak differently to investors than Wall Street typically advised. But the company also wanted the physical act of going public to be more in line with that Google ethos of the time. So Lise and the IPO team landed on a novel idea, something called a Dutch auction.
So look, what did Google do? It sold ads. How did it sell ads? It sold ads via auction.
The company generates the bulk of its revenue by selling ads that appear next to a search result. It recently expanded into shopping.
So we were, in many ways, the largest auction house in the world. And again, this goes back to the founders who said, wait a minute, we auction off our product, we want to auction off our stock. And so the idea to do an auction definitely came from them. They get the credit for the originality. I get some of the credit. There's a team, but I get some of the credit for executing on their vision. With a traditional IPO, the investment bank, you have a group of investment bankers. They are talking both to the company and then to the big institutional investors. And the company going public has put out its documents and put out its numbers. And then the bankers kind of go look for feedback from the institutional investors. Hey, what do you think this one is worth? And it's a two-way conversation. The problem is that the institutional investors have every incentive in the world to push the valuation down. They would like to buy the product for as little as possible. And the bankers pay a lot of attention to the institutional investors because they're buying IPO 1 on Monday and IPO 2 on Wednesday and IPO 3 on Thursday. And so you do not want grumpy investors. You want to cater to them every which way you can. And many companies going public are so happy to be going public, they don't deeply care whether they get $20 a share or $22 a share, although it means millions of dollars, presumably in the treasury, that they can then use to grow the business. So there is a conflict going on there. And bankers, again, through no fault of their own, but they're often conflicted. So the auction was trying to eliminate that.
A Dutch auction, as it relates to an IPO, gets its name from the bustling tulip market in 17th century Holland. It was a way of getting buyers and sellers in and out of the market at the price they wanted fast. Here's how it works today.
It was, you tell us what you want to pay, and we will treat you equally. And that's what makes it a Dutch auction. A regular auction, the product goes to the highest price. A Dutch auction, you look to see at what price you will sell all the shares, and that is the price you select.
Lise and the team took it one step further, setting up a system known as a dirty Dutch auction.
There had been so much chaos in the process that rather we had reserved the right to not have to sell the stock at the price where all of our shares would have gone, but rather we had discretion. And the founders decided they wanted to sell the stock not at the crossing price, which is the price we could have sold every share, was going to be $100 a share, but they wanted to sell it at $85 a share to say thank you to the tune of about 15% to the people who had come along with us and who had done the extra work, which you had to do to come up with what price you wanted.
Google's approach to the IPO differed all the way down to how they selected the banks they worked with. Instead of calling up the biggest names on Wall Street, they instead asked each of the major firms to answer a series of questions, each bank getting a different set of questions so they could spot any leakers. And they ended up working with a combination of banks they thought had been most creative. The lead underwriters for the IPO were Morgan Stanley and Credit Suisse, known then as Credit Suisse First Boston. You've got the banks on board. You've got this idea of an auction. What happens next?
Yeah. So we begin to try to work through the details. It's one thing to say you want to do an auction. It's another to figure out how you're going to do it. So how do you figure out the auction mechanics that try to keep professionals and individuals on an equal footing, but don't favor the big investors because you don't want to do that either?
Then there was the matter of the S1, the document a company files with the SEC to basically say, hello, public markets, we are a company planning to list, and here's what you should know about us.
And again, we felt very strong that it needed to be written in, not in legalese, but in a language that individuals could understand. And one of the things we tried to do, because we wanted to make sure that people understood what we did, was we tried to have 10 questions that investors had to answer before we would electronically submit the S1, the document to them. And again, it was unusual at that time to electronically submit, and everything had to be submitted, had to be available both in paper and online. And this was another little funny twitch. Everything we did had to be available on paper in case some of the investors didn't use the internet. But of course, we were selling a company that existed only on the internet. So did we really want people who didn't use the internet to buy shares in a company they could not possibly understand? Those were some of the SEC rules, but the SEC would not let us set out this question. These were not going to be hard questions, but they were going to be, do you understand what company you're buying and what we do? And frankly, do you understand that there are risks here? But SEC wouldn't let us do that. So we deep sixed the questions, worked on the document, again and again and again. Things got, as we were working on the details of the transaction, things became increasingly hostile with some of the bankers, with the board members, frankly, and the bankers, because it was so unusual. And one of the things we did that nobody had done outside of the media world was to have a dual class stock.
Dual class stock. This gave the founders greater control than individual investors on items that went to a shareholder vote. The founders had 10 votes a share, while the individuals had 1. According to Lise, this hadn't been done before in a tech company, but it had been used in media. And for Brin and Page, it was important they had the ability to still guide the company through big decisions.
Our competitor was Yahoo. And way back at the time, if you looked at Yahoo, the front page was jammed with ads. They were making so much money off that front page. And I believe this was Sergey mostly, was like, our page works because it's got our logo and a box where you type your question, and that's all. And we do not ever want shareholders to say, you could make more money if you turn that front page into a mess. So anyway, we put in the dual class stock. That caused a huge amount of heartburn for everybody and their brother. On lots of little things, we ended up, usually the company has lawyers and the banks have lawyers. In this case, we had a third set of lawyers in there representing the VCs. And, it was very bumpy.
Yeah, this sounds like one of those moments where things got a little hostile. What else ruffled feathers as you all designed the IPO?
Absolutely. That was definitely a moment. There were a bunch of them. The auction part was an issue. We were not going to let the banks allocate our shares. We were going to let the market allocate our shares. that got very hostile, partially because, again, the banks wanted to be sure that their biggest clients were happy. And we were like, too bad, you didn't build the company, not yours. So I would say there were quite a few smaller elements where things grew to be hostile because they were so different. But we had a number of unusual items designed to favor the employees and the new shareholders over the existing shareholders and the investment banks, and that got hostile.
When we come back, how the September issue of Playboy magazine nearly roiled Google's IPO plans.
Who's being cute putting a Playboy on my desk? And then you notice the front cover said the interview with the Google guys. And you're like, oh.
There was, as you neared the day, IPO day, perhaps a little bit, beforehand, there was an infamous interview that landed in Playboy with, I think, was it both Sergey Brin and Larry Page? Why did an interview in Playboy matter for the IPO?
Sure. There are SEC rules that are very clear about publicity prior to the transaction. You can do nothing that will hype the deal. And so companies go through, it was much more severe at that time, the rules have changed some, but something called the quiet period. And during the quiet period, you just don't talk to the press. You can run ordinary course of business, which is to say, if you launch a new product, you can put out a press release about the new product, but it can't say anything like, and we see a bright future ahead, or we think this is going to be an important product for us. You can't say anything like that. You could say we're launching this widget, and you can do press interviews about the widget, but you can't talk to the financial press. The quiet period usually starts with what's called the organizational meeting, where you've chosen your banks, you bring them in, you walk them through your game plan, what you're trying to do. In our case, we showed them our numbers for the first time because no one knew. Usually that's the demarcation for when you can't talk to anyone. Prior to the organizational meeting, the founders, who were, 30 years old at the time, gave into temptation and gave Playboy an interview. The people at Playboy were very smart. They took the interview and they sat on it. So rather than running it during the time when we were free to talk to the press, they sat on that interview. And they put it out a week, 10 days before our IPO, which, again, you're supposed to stay out of the press, particularly right at that point. That was quite a kerfuffle. I think probably all of us lost years off of our lives when we got back to our desks late one night after working on some stuff, and on everyone's desk was a copy of Playboy. And I, of course, had worked on Wall Street, and people do, crap like that all the time. And so I thought, really, who's being cute putting a Playboy on my desk? And then you notice the front cover said the interview with the Google guys. And you're like, oh, this is not some Wall Street stupidity. This is something that actually matters. So the SEC was not happy. The lawyers, both our outside counsel and our inside counsel, got on the phone with the SEC, explained what had happened, and then everybody read the interview. It turned out there was no new incremental information in the interview. There was nothing there. Thankfully, the SEC did not delay our transaction because there was no new information. But they did do something that I don't think they've ever done since. They made us amend our SEC filing to include the entire Playboy interview so that every single investor could have all of the same information without having to pay anything extra. So ours, I think, is the only S1 ever filed with a Playboy interview, and we like to joke that people clearly read our S1 for the interviews.
With the Playboy debacle resolved, it was on to the big day for Lise and Google.
But there was a lot of fussing the night before, and our original price range had been higher, and then investors balked, so we brought the price range down, and then we sat in a meeting, and I think they selected 85 as the price. Half the team flew to New York to ring the bell. And Larry, for instance, Larry and Eric and a bunch of folks went to New York. And then Sergey and I and some other folks stayed back in California, dotting the I's and crossing the T's on some of the things that needed to be done.
And after all that preparation, at the start of trading on the NASDAQ that August day in 2004, GOOG was a stock that the public market could now buy and sell.
And here comes Google into the stock market. Jeffrey Brown has our story.
Several years ago, Google entered the English language, meaning to search for something on the internet. Today, Google entered the stock market. Shortly before noon.
When you think about this moment, this IPO and everything that led up to it today, how did it influence the way going public is done?
First of all, dual class has become incredibly common now among technology stocks. That was not the case. That totally keyed off of Google. Secondly, I like to work with my clients on doing something called a hybrid auction, where we do try to get more data on where different types of investors are in terms of what they're willing to pay. And then we can use some discretion in allocating the stock. And I think that's become significantly more common. Most importantly, I suppose, the biggest impact is that it opened all investors' minds to the ways that there are different ways to do things. Whether you're a fan of them or not, direct listings wouldn't have come along. SPACs were this tiny backwater thing, which frankly, they should become a tiny backwater again, in my view, but that's also different. Investors suddenly understood that there was not investors and issuers, and much to their chagrin, bankers, understood that there are different ways to do things, and managements have much more say in how they want to pursue this. Lots of companies go public for lots of different reasons. And why shouldn't the process be optimized for this company in this market at this time? Businesses should not go public doing it the way the last one went.
Lise, you started our conversation today by saying, you wanted to go into Google to figure out how does this process, how does the company in this stage actually work? Let me go into the finance department. I'll offer my skills and I'll learn something in exchange. What did you learn being right in the center of the Google IPO?
Oh, gosh, and being in the center of the Google IPO, I learned the biggest lesson, which is because that's the way it's done, is almost always the wrong answer. I learned flexibility. I learned that no is the wrong answer, and let's see what we can do is the right answer. I learned that some of the rules can't be bent. I knew that, but some of them cannot be bent. But it did certainly open my mind, and mostly I learned the piece that made me start the business that I run now, which is management teams need somebody who really understands all the nuances of this process on their side to be able to fully explain to them what all their options are, to make recommendations to them on which path to pursue, but then to execute whatever path they choose as effectively as possible for whatever goal they're working toward. So I learned to be more thoughtful and creative and to listen more, I think. And I learned that there is no one right way. I think the key is question your assumptions, right? It's actually Ayn Rand. If you assume something has to be done that way because it always has been, stop and make sure it really has. It really has to be. And sometimes it does, and sometimes it doesn't.
That's it for this episode, but you can hear much more from my conversation with Lise Buyer by subscribing to Brazen Plus on Apple Podcasts. She goes in depth on how Google's approach to the IPO riled up bankers on Wall Street.
I had the pleasure of telling Hank Paulson, who, kind of became a big deal later.
No kidding.
I had the pleasure of telling him, no, you're not invited. And we had to do that with several of the major investment bank CEOs.
The Closer is a production of Project Brazen in partnership with PRX. Our show is produced by Isabel Kirby-McGowan, Trina Menino, and Anna Muto. Ben Walsh is our reporter, Mariangel Gonzalez is our project manager, and Lucy Woods is head of research. Megan Dean is programming manager, and Ryan Ho is design lead. Golda Arthur is our showrunner, and Bradley Hope and Tom Wright are executive producers. Our marketing consultant is Maggie Taylor, and I'm Amy Keene. Thanks for listening.